My name is Melvin Escudero. I am the chair of the Advocacy Council for Latin America and the Caribbean markets at the CFA Institute. We are very pleased for your presence on this important seminar. In our council, we are doing a great effort to discuss some of the most important topics for our region, for our capital markets and the financial markets. In this occasion, we have a very important panel of experts around the world and Latin America regarding ESG trends, how this big tectonic shift in the capital global markets is taking place will reshape our situation, our opportunities, and our risks in the next future. Most of the large corporations globally, I mean the multinationals, the multilatinas, and the largest companies in each country right now are preparing their companies to be ESG compliance. This is a long-term trend, but at the same time, it's a huge challenge for most of the companies. CFA Institute, as a global association that represents the professional investors in the world, since this year is promoting also a new exam, the ESG exam, that is another one related to the CFA, a traditional certification exam. But this new exam is bringing the importance that these ESG concepts and trend and new mindset is gaining on the world. No? The global markets in recent years after the pandemic, COVID-19, has showed a strong and reinforced trend through ESG, not only in equity, but also in bonds. The sustainability bonds, green bonds, blue bonds, social bonds, it's growing at a rate that is really amazing. And if we continue with the climate change schedule for 2030 and 2050 with carbon zero, the change on the marketplace will be really, really huge. So I am very pleased to introduce first to Chris Fiedler. He is from the CFA Institute, and he will do an initial keynote speech for us. Go ahead, Chris.
Hello, everyone, and thank you, Melvin, for having me here. It's a pleasure to kick off this event. And the topic today, ESG Trends, reminded me of some work that I did for CFA Institute 18 months ago. And that work was to help put together a strategy for how CFA Institute should address ESG. And one of the first things we did was to look at the trends, the drivers, about why this was an important issue for the investment profession. And there were three things that we identified, three trends. There's a significant market demand for ESG products. ESG is an increasing part of the regulatory landscape. And climate change has made ESG more important and more urgent. And as I was preparing for this, I thought to myself, wow, I think those three trends are still very much going strong. And I wanted to bring in some recent events and news articles just to demonstrate how important they are. On April 9th, the SEC, the regulator here in the United States, put out a risk alert. And in it said that the rapid growth in demand and increasing number of ESG products and services and lack of standardization and precise ESG terminology present certain risks. For instance, the variability and imprecision of industry definitions and terms can create confusion among investors if investment advisors and funds have not clearly and consistently articulated how they define ESG and how they use ESG-related terms, especially when offering products or services to retail investors. They went on to say that they've noted gaps in their examinations. For example, a lack of policies and procedures dedicated to ESG investing, or that those policies and procedures were not followed or not implemented, or that they were weak or unclear, or that they did not align with the ESG-related disclosures. Then in April 30th, I saw an article from Morningstar, It said that in the first 3 months of 2021, inflows to sustainable funds were 21.5 billion, which exceeded fourth quarter inflows of 20 billion. And that 21 billion inflow was twice as much as the prior period the year before, and 5 times as much as in 2019. So while sustainable investment products may still be a smaller part of the entire landscape, it is quickly growing. On June 11th, then, the SEC said that released their annual rulemaking agenda. And as part of that agenda, they are considering rules to address ESG disclosures, both at the investment manager level and the product level. And finally, you probably saw last week, August 9th, the Intergovernmental Panel on Climate Change released its 6th report. And in it, it said that human activity was responsible for 1.1 degrees Celsius of warming since 1900. And that in the next 20 years, we're very likely to hit 1.5 degrees Celsius, which is a major milestone. And that if we do not take immediate large-scale action, that we will exceed 1.5 degrees and maybe even 2 degrees. So this is a very important global issue that I think we all need to be paying attention to. Now, one of the next things in the strategy that we set out was what do we want to accomplish as CFA Institute? What are our desired outcomes in terms of ESG? And we laid these out in broad terms. The first was to create a regular stream of high quality ESG content that's curated, amplified, delivered by CFA Institute and CFA societies. Second, we aspire to train investment professionals who are able to analyze, understand, and communicate the financial effects of ESG factors and risks and opportunities, but as well as how investments would impact the environment, society, and other stakeholders. And third, we said that we would like to see ESG regulations and industry standards that are effective and efficient and consistent and provide a level playing field for investment managers and provide transparency and comparability for investors and clients. Now, I'd like to tell you how we're doing against those goals or those desired outcomes. First, in the area of research, in September 20, just over a year ago, just less than a year ago, we put out a paper called Climate Change Analysis in the Investment Process. It was very well received and I think provides a lot of good information for investment professionals about how to think about climate change, again, how to incorporate that into their analyses. In December 2020, we put out a paper called The Future of Sustainability in Investment Management. Again, an excellent look at the changing landscape and how the industry is incorporating sustainability and how it might look going forward. And last Thursday, Paul Andrews, who is a managing director and who oversees our research, advocacy, and standards functions, introduced a new plan to incorporate more original leading research and influential thought leadership. And we are going to do this by bringing together industry luminaries, regulators, scholars, subject matter experts, market analysts, and the next generation of industry leaders. Also, in the last year and a half, we have rolled out the global, we've done a global rollout of the ESG certificate it's the certificate in ESG investing. And that certificate was developed by the CFA Society UK, which I think is just really phenomenal that we have societies that are able to develop professional certifications and that we can use the reach of the CFA Institute as a global body to get that certification out into other markets. That rollout started in January of 21, and I believe it's been launched in Brazil. We launched in key markets to start with, and that will be expanding in the future into other markets. What we've found so far is that this certification appeals to people in research, in product development, risk, financial advisors, and portfolio managers. And that, at least in the UK, approximately 85% of those who have sat for the certificate are non-members. So clearly, we are reaching an audience beyond our existing membership, and we're attracting new people to what we do. And finally, we've been working hard on the ESG disclosure standards for investment products. Now, what this is a mechanism that would allow investment managers to better communicate and investors to better understand the ways that an investment product would incorporate ESG information, address ESG issues, or consider investors' ESG preferences. And on May 19th, we put out an exposure draft of those standards, and we are now reviewing the feedback and making revisions along with our volunteer ESG technical committee. And we are on track to release a final version of the standards by the 1st of November in time for COP26, which we will be participating in. And I'd like to leave you with a few final thoughts, and that is, why is ESG and sustainability important for investment professionals? The first, I have three things, maybe three questions to leave you with, three things to ponder. The first is that we are experiencing just transformational change in terms of the risks that we are facing. Transformational changes in terms of government policy and how we respond to those risks, and a transformational shift in client preferences. And my question is, how will the investment profession respond? Will it be an obstacle and resist these changes, or will it be an enabler? My second point for consideration is the investment profession obviously cares about clients' wealth. That's kind of what we're seen by other people as doing, as people who are good at managing money and help creating wealth. But my question is, can the investment profession also care for people's welfare, their well-being? And by that, I mean, we may be able to create wealth for people, but what sort of life will they have in 30 to 50 years if the world is on fire? So perhaps as investment professionals, we can bring more to the conversation, not only about how people can achieve their financial goals, but the kind of world and life they'll have when they reach that future retirement goal. And finally, the investment profession helps build and maintain market integrity. And that includes addressing market failures and externalities. And I think if we're not careful, perhaps maybe the biggest market failure in history might be the failure to price carbon. I think it's absolutely essential, personally, that we have a carbon pricing mechanism and that we bring that to bear in terms of how carbon is used and allocated around the world. And my question is, how can investment professionals be part of that and advocate for carbon pricing? So our vision at CFA Institute is to empower investment professionals, empower the industry to tackle the world's greatest problems and help realize the world's greatest possibilities. And I know that the people here today are part of that journey, and I know that they're inspired to do that. And I know that you have some great speakers here, and I think that you will have a great conversation today. Unfortunately, I won't be able to stay for all of it. So with that, I will conclude my remarks, and thank you once again, Melvin, for having me. I very much appreciate the opportunity to speak to you and the other audience members today.
Thank you very much, Chris. Now is the turn of our panel. I introduce you to Barbara Meiser. She's the president of CFA Society Uruguay and also a member of the Advocacy Council for the region. Welcome, Barbara. Go ahead, please.
Melvin, thank you very much. Good morning to all. Thank you for being here with us. And it is my great pleasure to moderate a panel of leaders from leading companies also in respect to ESG. So let me give some housekeeping details. Each participant Each of our speakers will be presenting for 10 to 15 minutes. And at the end, we will have a panel discussion and a Q&A. You can make your questions through the chat button at the bottom of your screen. And before introducing the first speaker, let me briefly contribute to what Chris just said, framing the importance of ESG and what this is all about. First, as Chris said about the importance of these topics, climate risks are amongst the largest risks we face, both by likelihood and impact. And governance and social factors are increasingly important. They are also central for creating a world worth living, on the kind of world and life we will have, as Chris said. In the past, asset management was about return, then about risk-adjusted returns, and now we are adding a third dimension, the impact of our investments. We have to understand the impact and measure it and make sure that through our investments, we contribute to the sustainability of our planet and a better quality of life, again, mentioning what Chris said. And capitalism has been great in so many aspects. It ensured enormous creation of wealth and lifted hundreds of millions of people from poverty. But there are certain things that the market will not take care of. Chris mentioned market failures, and I will be a little bit more broad. Climate risk and a more appropriate income distribution, market will not take care of this. Private sector and the financial sector in particular have a key role to play here, joining governments and other institutions. And the power of our investments is enormous. You know what it means if we tell a company we will lend to them or invest with them if they do certain things? Finance industry has unparalleled reach, and ESG gives us the opportunity to link value with values, to make a difference, to contribute. And today, I have the privilege of moderating a panel of leaders of leading companies that are doing all this. They are walking the talk, they are doing a difference, they're making a difference, and they're showing us the way. We will have the opportunity to listen to their views, to learn from them, and to see what they are doing and how they are doing it. And these accomplished leaders have such extensive resumes that in the best interest of time, I will only introduce them with their current titles. And now it is my great pleasure to introduce our first speaker, Margaret Dorn. Margaret is Senior Director, Head ESG North America Standard & Poor's Dow Jones Indices. And as you all know, Dow Jones has developed the Sustainability Index series that track the stock performance of the world-leading companies in terms of economic, environmental, and social criteria. Margaret, thank you very much for being here with us. It's all yours.
Thank you, Barbara, and thank you, Melvin, and the entire CFA for having me participate in today's webinar. Give me a quick second as I attempt to share my screen here and hope that we don't have any technology failures, but let's see here. All right, Barbara, if you could just give me a quick thumbs up or an okay and let me know that we can see everything. Okay, fantastic, and good morning to everyone, and again, thank you for joining us in this incredibly critical and relevant conversation around recent developments in the ESG space. As a part of S&P Dow Jones Indices, as a part of S&P Global, the vast majority of my comments will really be centered around what are some of those developments in terms of ESG data, also in terms of ESG data aggregation, and then how all of that is being applied into the index form. So I'll try to get through this all as quickly as possible. As I'm sure all the speakers can relate to, we could probably all spend the vast majority of the hour on our portions, but we'll just try to keep this to some of the high level points. Given some of the comments that Barbara, that Melvin, and that Chris made earlier, this should probably come as no surprise, but there has been a rapid rise in both the number of ESG ETFs as well as the assets invested in these ETFs over the past several years. According to a report issued by leading ETF data provider, ETFGI, assets invested in those ESG ETFs and ETPs, or exchange traded products, reached a record of 280 billion at the end of May. So if you break that down and just look at this year alone, we've seen flows into these ESG ETFs almost triple in comparison to what they had collected during the same time frame last year. And with those flows has obviously become, or has brought forth this, for lack of a better term, proliferation of product, both in terms of the number of ETFs and exchange traded products that have launched over the past several years, but as well as the number of ESG and sustainable indices that these funds are designed to track. So to add another data point to this, just because I thought this was incredibly interesting, I read somewhere recently that there are somewhere around 37,000 sustainable indices being calculated or exist worldwide, which is just an incredible number when you think of it. Still, a small percentage overall of the number of indices or broad market indices being calculated, but still a massive number of indices. And with this rapid rise and acceleration of growth in this space, there's been these obvious growing pains. And these growing pains tend to be centered around confusion and misunderstanding of the objective of ESG indices and the benchmarks that are being designed, as well as other sustainably focused investment strategies. But much of that confusion is really centered around the ESG data sets and that are ultimately being utilized and implemented at the core of each of these products. So that's always why it's great to hear from Chris speak about the work that he and the CFA are doing to really provide some level of harmony around global ESG standards, because ultimately how those metrics are defined and reported on is incredibly important. And as both an index provider and an ESG research and data provider, it's something that we are very sensitive to and obviously incredibly mindful of. And we continue to evolve our ESG research and the way that it is deployed into our indices to address both the regulatory changes as well as the requirements, as well as the kind of evolving definitions around these global ESG standards that Chris addressed earlier. So with that in mind, I thought it might be helpful to share a brief overview of S&P's history in this space, and more particularly how our ESG data and indices have really evolved over the past several decades. So first and foremost, even though ESG and sustainable indexing has really taken off over the past several years, this is not something that is new to S&P Global, or to S&P Dow Jones indices. This is not just something that we've recently identified as a priority. This is something that we've been doing for quite a long time. Barbara mentioned this earlier, but in fact, we launched the first ever global sustainability benchmark, the Dow Jones Sustainability Index, over 20 years ago. And since its launch, it's really become kind of the gold standard of sustainable indexing. And inclusion in the index has long been considered this badge of honor by these sustainability champions around the world. So quite frankly, when you look at the history of the Dow Jones Sustainability Index, it's really pioneered sustainable indexing and has ultimately shaped how corporate sustainability practices exist and how they've evolved over time. So since the launch of the Dow Jones Sustainability Index, we've vastly expanded our definition of sustainability-driven index strategies, and we cover various areas that fall under what I consider kind of that sustainability umbrella, including indices with climate objectives, which is a key consideration today, with utilizing our True Cost database. So we have this the True Cost Climate database, which is world-renowned in terms of its the data set and the granularity of the data set. But we have these indices with these climate objectives like carbon efficient strategies or Paris aligned or climate transition indices, as well as these more broad-based ESG indices, including, I think most notably, an ESG version of the S&P 500, which we launched in 2019, that is designed to closely track the parent index and offer the similar risk return to the 500, but with both meaningful and measurable increases to the sustainability improvements of the index over the parent. So I think a point to focus in on is that, that the main driver that has made the launch of these more kind of innovative index construction approaches possible has been the emergence of new data. And that has made it increasingly possible to shed a light on the financial materiality of ESG issues and ultimately how well companies are positioned to deal with them. And while, recent increases in public disclosure and documentation have definitely been assisting in, filling those sustainability data gaps, there still remain many voids on what is actually being reported. And that is why, rather than just relying on public disclosure data, at S&P, we go beyond that and we engage with companies directly on their sustainability practices and models through something we call the corporate sustainability assessment. So we use this corporate sustainability assessment to engage with companies directly to collect our ESG data. And that data is ultimately what we utilize to formulate our ESG scores. And that's the foundation for many of our ESG indices. So very quickly on this corporate sustainability assessment, the questionnaire really allows us to gather a more granular set of ESG data that has also really helped companies. So if you look at how it's helped companies, it's helped them to bridge the gap in their own sustainability journeys by providing a framework for which they can think about sustainability. And this applies even more particularly in regions where regulations, investors, or even consumers have historically lagged behind in sustainability thinking. So each year, new topics are added to the CSA and the scoring methodology is enhanced. That ensures that it stays current and really pushes for advances in corporate behavior and in those industry standards on ESG. One other thing just to take note of in the CSA is that it applies this best-in-class, industry-specific approach, and it compares companies across 61 different industries. And it assesses them through a mix of both general and industry-specific questions. And that industry-specific approach is incredibly important because it allows us to really hone in on and address the most relevant and ultimately financially material issues for a given industry. And I'll speak to that a bit more when I get to how we calculate our ESG scores in a few slides. But very quickly, I thought I would share first, before going into that, a few snapshots of the recent participation rates of companies both globally as well in Latin America, because I think it really highlights the growing importance and emphasis that companies are placing around transparency of their corporate sustainability practices. So, since the first CSA was launched over 20 years ago, participation of the invited companies has really steadily increased, but there was a notable jump in participation for the 2020 assessment year. It actually increased over 19% over that 2019 assessment. So of the 3,500 companies that were invited to participate in that assessment, last year, almost 1,400 companies completed the assessment and directly engaged with us in completing that assessment. I should also note that we've seen an increase in the number of invites. So we've increased the number of invites that we've sent to participate in the CSA to about 5,000 companies this year. And once again, we're seeing this similar trend of record participation, record engagement by those companies that have been invited this year. So if we look at the regional breakdown of participation, Latin American companies in particular represented about 10% or so of the total participation in 2020, but we are definitely seeing a significant increase in participation levels in the region for the 2021 methodology year as well. Just by looking at this slide, we'll go through this quickly, but what you're seeing here is that these rates of participation year over year over the past few years have dramatically increased, particularly looking at those numbers in both North America and Latin America as well. And on this last slide of participation, I wanted to briefly cover, because I think this is just an important snapshot of the coverage of the CSA within the Latin American countries in particular. And this is looking at the participation rate in Latin American countries with the most invited companies, which was around 36%, which is pretty much right in line with what we've seen in terms of the global CSA participation rate of about 40% or so. And why I wanted to share these participation snapshots as well is because what this shows us is that there is definitely still work ahead of us. So we haven't solved the equation necessarily. And we're still, looking for ways to engage with companies. But what I think is important to recognize is that this expanding universe of coverage as a result of these increased participation rates, specifically in Latin America, has ultimately allowed us to construct these local indices in markets like Brazil, Mexico, Chile, Peru. And that would not have been possible without such a granular data set that's a direct result of that corporate sustainability assessment. So I've spoken a lot about how we collect the data and what we do with each of our, and how we aggregate. But I thought I'd spend a little bit of time about discussing how we take that raw data and aggregate it into the actual ESG scores. So out of each assessment, we were able to gather around 1,000 data points, and those data points are then used to aggregate a company's total ESG score. And that is ultimately done by taking the weighted average of all the criteria scores and the respective weights, and then each individual ESG dimension being the E, S, or G, is the weighted average of all those criteria scores and weights within those specific dimensions. I know it's a lot of words, and I can happy to address any questions and get more granular about this. But as a final result of the total ESG score, it's ranked from about 0 to 100, with 100 representing the best performance. But I think one last point, and is most critical to understanding our scoring approach, is that the data we use to derive the S&P ESG scores is rooted in that principle of financial materiality, meaning that companies should be assessed according to the sustainability issues that are most likely to arise and to have the greatest impact on companies in their industry. So collecting and scoring data according to these factors really ensures that companies included in our ESG indices have been measured based on both the sustainability issues that are most relevant to them and could have the greatest impact on them. And this is done by weighting issues according to their relevance, again, industry by industry, as determined by how likely issues are to arise and their likely of impact if they in fact do. So this chart right here just provides a brief snapshot of one of the industries, and particularly the pharmaceutical industry. And that green circle represents what I like to call the sphere of influence. And that sphere of influence has inside of it several criteria that could have a dramatic effect on long-term corporate performance or value of a company within the pharmaceutical industry. Now, this chart or this graph would look very different in terms of the criteria within that circle if we were to examine an industry like the energy industry group. So really focusing on what is most financially material and relevant to a given industry and weighting that accordingly is at the core of our scoring framework. So just a brief snapshot of where our indices are, what we cover across the board. We really break our indices into these 4 different areas: core, which would represent things like the Dow Jones Sustainability Index, the S&P 500 ESG Index, a lot of those ESG data integration type indices. Then we also have a very advanced line of climate-related indices that integrate things through our data, like through our true cost data sets, like physical data risks, carbon trajectories, really important data sets to understanding a more holistic approach to climate investing, and align with regulatory changes mainly coming out of the EU around Paris aligned and climate transition benchmarks as well. We also have thematic indices that get a bit more sliced as far as what their coverage and objective is, and then a growing subsegment of fixed income indices as well. So I'm probably already over time, so I will stop there. But if there's any questions around these indices or how we approach ESG data and index construction, happy to do that during the Q&A.
Thank you very much, Margaret, for this detailed and so clear explanation. amazing, the growth that all this is experiencing, the increasing complexity, and it has become almost mainstream, but you have been doing it for more than 20 years. Some questions are already coming in, but we will spare them for the end. So thanks again. And now it is my great pleasure to introduce our next speaker. Our next speaker is Aldo Ferrini, the Chief Executive Officer at AFP Integra, the largest pension fund in Peru, which is in turn owned by Grupo Sura, the largest asset manager in the region, and also a leader in ESG, and of course included in the S&P indices. Aldo, thank you very much for being here with us. The floor is yours.
Okay, now I was in mute. Okay.
Yeah.
Okay. Thank you, Barbara, for the introduction. And can you see the presentation?
Yes.
Okay. Perfect. Okay, so I'm going to share with you what are the views we have on ESG from both Integra, which is the pension fund I run, and Grupo Sura in this view. So listening to Chris and Margaret, they've said a lot of things that we really believe in. We are, and also what you said, Barbara, regarding the trends on investing that went from risk adjustment return, and now impact investments, and we are completely agree with that changes. And ESG, it's a matter of managing risks, and for us, the fact of including this new, or not so new, from Margaret's presentation, but really kind of new for our region, variables in order to decide where to invest, is a matter of generating sustainable returns in the long run for our clients, and to generate not only client wealth, as Chris mentioned, but also creating welfare to our clients and to our future generations. So from our portfolio, and this is I think particularly in pension funds in Latin America, we manage our portfolio with a local portfolio and a foreign portfolio. And the way we address ESG variables is completely different in both portfolios because of the data we can collect in the different markets, and because of the impact we can generate in the different markets. So what are the challenges we have in our portfolios in order to implement ESG? The first, and is what S&P and Margaret commented, is critical on data. The collection of data is critical in order to decide where to invest. And the data we can collect on the local investments, local companies, is really is weak. There's not a lot of data, and the data needs to be collected by our internal teams. And we need to learn to measure that data, not only from the company perspective, but to measure it in our portfolio. And for that, we use both providers, but also, as I mentioned, on the local portfolios, we need to measure it ourselves using proxies on what we learn from more experienced companies as S&P and Dow Jones. The other critical piece for us is to inform, to report to our clients, to the market, what we're doing. This is not only a matter of measuring what we have, but we need to report and to be transparent with what we're doing, not only to let our clients know where we stand, but to also let them question what we're doing and to check that what we're doing is what they are expecting. There are a lot of companies, and in Peru there have been some critical cases of companies that really report what they did, but the market was not strong enough to make the due diligence of what they were reporting. And after the fact, we learned that the reporting was not based on reality. There's a experience in Peru with a construction company that went broke because of extreme corruption, that received most of the prizes and recognition of the market on corporate governance. So reporting and the responsibility of the market of investments to really make a good due diligence on what is reported is critical. The other important thing we see on ESG is participation, the activism. We need to be active investors, especially on the local portfolio, because of the impact we can generate in changing trends, in changing the way companies see ESG or the relevance of ESG. We are big shareholders in some of the most important companies in Peru, and I think the investment community is in many ways is much more advanced on ESG than local companies. So here it's very important to really collaborate, and that's the fifth issue, with companies to set a plan to grow on ESG. It's not about saying I'm not going to invest in this company because they are very weak in ESG, but to analyzing what they are doing and to work with them and with us, because we are also kind of new on improving ESG. So in the way we decide or when we decide to invest in a company, we are not just measuring the today, but analyzing the plan the company has and to work with them in this ladder of improvement. And in the international portfolio, the strategy is different. I mean, there's a lot of information, and what we need to do is to move our current portfolio to a portfolio much more aligned with what our ESG objectives are. So we manage a portfolio which is 50% local, in which we are really working with the market, working with the companies to improve data measurements and to be very, very active with them. And our foreign portfolio, which we are analyzing it from inside to try to change it and to move it to a more ESG high-grade portfolio, let's say. So in Sura, as Barbara mentioned, Sura is the biggest, is the shareholder of Integra. We are really committed in ESG. It's a strategic pillar for us, and we know we can do it, and we can generate a big impact in Latin America. And here, what you see is the different activities we are pursuing in 2021. We're looking to ESG integration. We are looking to engagement, decarbonization, and to formation of ESG training our teams in ESG. And that's something I've seen in most of the asset managers in Latin America. We do not have special teams formed in ESG, and we kind of decentralize the ESG roles within the teams. I think there's a room to really form or to create specific ESG teams in the management team. And the strategic focus this year or for 2021 is climate change, and that's where we are putting all of our efforts in this year. We are participating in a lot of questionnaires and a lot of rankings to see where we are before doing a lot of things with our portfolios. We really need to understand where we are, and from there we need to set our goals to where we want to be in a couple of years. And this is a little bit more of our plan. There's a lot of communication, and there's in the last few points, there's a lot of analysis of our own portfolios. What we're doing on fixed income, what we're doing on equity, what we're doing on mutual funds, local and foreign. So the work regarding ESG at the beginning is really huge. We are signatories of the PRI. There's a lot of information to gather, and it's not only about information but about commitment. We need to really show in our data that we're improving and that we are really committing to be part of PRI globally. We are also, and this is from Peru, and I will talk a little bit at the end. We are members of the PIR, which is a kind of a similar that PRI, but a local institution that really aims to generate a local Peruvian ecosystem focused on ESG trends. We are part of the Dow Jones Sustainability Index. We are been there 9 years, and you can see there some of the other activities we have. Going to our portfolio, and here you can see how we have been managing our portfolio, and the top two pies are of March 2020. The bottom one was on December 20. And you've seen the huge effort we have gone through in order to measure ESG on our portfolio. And by March 2020, we had only 20% of our fixed income portfolio measured, and we've managed to go to 100% this year. There's a lot of issuers that we've done the work one by one, the local issuers with our own questionnaires. You've seen we have around 80 issuers in Peru, and we have now measured most of them. Probably the data here, or the measurement of risk is not perfect because the information we have is not very good. But we need to start from something, and what we need to do now is to try to move our portfolio towards a higher grade in ESG ratings. This is another analysis we do with all of our portfolio. This is a snapshot of our fund 3, which is the most aggressive fund in terms of risk. Is mostly equity and private equity, and we do an analysis using the different sources of where we are and what's our rating. If you see the graph or the pies at the top, we are measuring not only our portfolio but our peers, our competitors, and to try to not only to see where we stand from an absolute terms, but also in relative terms, how are we managing our portfolio. And we are active in most of the companies where we invest, which are contributing negatively to our ESG ratings. And this is not in order to decide if we are going to sell or not the participation we have on that company, as I mentioned earlier, but is to understand where they stand, what are the plans of these companies, and if we see them understanding ESG in the way we do. For example, if you see the company's name, you see UNACEM, which is a cement company that is one of the first companies in Peru that have presented a plan, an open plan on ESG. And even though the rating is not very high today, we are confident that they are working in order to improve the ratings, and that's for us has a huge potential, not only for the impact that company can generate, but also on the impact this company can have on returns on our portfolio. So understanding where we stand, understanding where the companies are today, and what are the views is critical for us in order to generate positive returns that can have impact in our society. And this is a very interesting graph that in which we measure all of the mutual funds we have. These are foreign mutual funds, and what you see there are in the horizontal axis the ESG score, and on the vertical axis the ESG score compared the peer score. So if you go to the bottom right, that big green ball, it's an ETF we hold invested in Europe, and you can see, or you can see there that it's low regarding peers, but from an absolute terms, it has a very positive rating. So our priority is not to go to the upper right-hand quarter, but to move the bottom left quadrant upper in the scale. And what you see there in the red balls is emerging markets. And what strikes us is that in the emerging markets, the absolute rating is very low. So there's a lot to do in emerging markets in order to move to the right on the absolute score to generate more returns. And that's what we want to do from our local portfolio. Try to either change our allocation, changing funds from this fourth quadrant to move up to the first quadrant in emerging markets, because as you can see, there's not a lot of options on the right-hand side of the chart. And on our US funds, for example, there's a lot of space to improve, both on absolute and relative terms. So this is the way we are trying to analyze our portfolio and to see what are going to be to set our priorities for the next couple of months and years. And it's, as you can see, all about that. It's impossible to implement any strategy if we do not have the data analyzed and the data really implemented in our different asset classes in the portfolio. And on the local portfolio, what we've been doing, we've been very, very active on shareholders meetings. I think we strongly believe that the shareholders meeting is the most important meeting a company has in a year, and is where we as shareholders can share our voice, not only with the company, but with other shareholders. And the power of sharing our views with other shareholders is really huge in order to make a change on the company. We've seen it in several companies in Peru when we had the conversation one-to-one with the company, the impact or the relevance they took from what we were saying is completely different from what they accept when we open the discussion with different shareholders, and they can really see the company that ESG is something that a lot of shareholders are really taking care of. So in 2020, we assisted to 21 shareholders meeting. We voted in 121 issues. Obviously, not everything is in favor. We have 25 issues where we voted against what the company was presenting, and really that's something that in Latin America specifically, voting against is not very well seen. Shareholders meetings or the board of directors usually want to approve things with 100% of votes in favor, and the fact of voting against is really a powerful tool. Not only because of not just because of voting against, because it's only when you vote against that discussions really go active. So I really encourage you, if you are participating in shareholders meetings, to really analyze and the proxies, analyze the issues you need to approve or not, and if you are against of something, to really speak out and really have the arguments to explain why your company or your fund is voting against. And finally, and this is especially in Latin America, I think collaboration within asset managers, within investors is really critical. The power of working together is really a strong tool to move the market. In Peru, we launched with some companies, several companies you see there in the chart as partners, the PIR, which is this effort that tries to articulate this ecosystem of ESG in the financial markets. And we start small in 2015. We now are more than almost 20 partners with some very strong strategic allies, as you can see there, Amundi, the IFC, the PRI, and we manage more than 80 billion US dollars in assets. And at the bottom of the slide, you can see two things that we have really accomplished. We as PIR are working with the UK Pact in a very strong project in order to measure the portfolio of different asset managers, in order to help them or help us, we are part of the program, to understand where we are and to understand how can we improve the investment of our portfolio, especially in the Peruvian financial ecosystem. And the other thing we have managed is to work very closely with regulators, and with the PIR, the local regulator, and the Consejo Consultivo del Mercado de Capitales. We managed to work a new piece of regulation, which is called the Sustainability Report, that all issuers regulated by the Superintendencia Mercado de Valores, the local SEC, are mandated to report every year in a very simple way, in a very with very clear questions that have been made by investors. So this is a report that investors really want to have, that we have prepared questions that really are useful for us, and is I think a key milestone in order to improve ESG reporting in Peru. So that's what I have to present. I think we strongly believe on the impact of using ESG variables, using ESG as a key part of the portfolio, and as my colleagues have mentioned before, I think that the future is here, and the potential of ESG investment is really huge for us and for the market. And I end there, Barbara. Thank you very much.
Thank you very much, Aldo, for sharing what you're doing, how you are doing it. So many challenges with data collection, reporting, analysis. Thank you for highlighting the importance of due diligence, and it reminds us from greenwashing and so on. And your comments also reminded me on Margaret's comments that growth comes with growing pains. And you also very clearly showed how much commitment and hard work this all requires. And now it is my great pleasure to present our next speaker, Daniel Celano, who is the country head of Schroders in Brazil. Schroders is one of the leading asset managers in the world and has had for many, many years a strong focus on ESG. Daniel, thank you for being here with us. It's all yours.
Thank you, Barbara. It's a pleasure. It's a pleasure to be here, and I will try not to tackle the same points that our colleagues just did. But before I flip some slides and eventually, do that in less than 15 minutes, so we can save more for the debate in the panel. Also considering the Brazil ESG trends in the local industry, I think that's important to mention what is ESG for Schroders. I think the initial remarks about the lack of some sort of standardization there makes some people not to understand exactly what happens and the implications and risks and opportunities that might arise from this topic. But in Schroders, we tackle ESG, first of all, very seriously, but the way we tackle is pretty much in 2 points. The first point is we have a fiduciary duty with our clients, right? And basically what we want to do is to be in a position, in 100% agreement with what you said in the beginning, Barbara, about the first, generation of asset management was return. Then you had risk-adjusted return, and now you have risk-adjusted return plus the impact in ESG. So that in mind, we have a view that as our fiduciary duty to clients is to find the best opportunities in the market. And in order to find the best opportunities in the market, we need to take into account other factors, not just the balance sheet, but other factors that surround the company. And so we can be in a position to find the best and more resilient investments for the future, for the long run. And secondly, is how we tackle it in terms of mitigating tail risk, right? Basically, the tail risk is something that has a very little probability to take place, but when it takes place, it can hurt you very bad. And I think that these 2 dimensions drive everything we do in Schroders about ESG. Of course, we do have different ways of tackling it, but we don't necessarily do a kind of morale discussion, what's best or not, what's not best, but also taking into account what Aldo said, we find the companies that can make the transition. However, we are not complacent with these companies. If they have precise milestones, if they don't follow these milestones, we are probably disinvesting or not holding or not rolling over that debt because we do that for both equities and credit, including in Brazil. We have a special situation in Brazil whereby our credit team that takes care of Brazil currency, credit, plus Latam bonds and also equities, they are integrated. We have people in Brazil, people in New York, people in Chile, people in Argentina, people in London that does that with a much broader view. So I will flip some slides with that in mind and try to show a little bit of what we do, but not taking a lot of time to make it work, but just to show how we are kind of positioning ourselves on that regard. Can you see my slides? No.
Yes. You can see them.
Yeah. But do you see the slideshow, or do you see the?
We see both the slide and a slideshow.
Okay. So sorry. Let me try again. Just a second.
Maybe if you put like presentation mode.
Yes. Just
now.
Yeah. Here. Screen 1. Let's see if you can see that.
Perfect. Yeah.
Okay.
Now. Okay. Now. Perfect.
Okay. So sustainability insurance is probably like from 20 years. And we hired the first ESG specialist in 1998. We do have a lot of 22 specialists dedicated to ESG. And we have, one of the first active asset manager that attached, cost of capital to sustainability goals. So we do engage very, very much on this topic. And in terms of the integration of ESG, of course, we need to take into account all these kind of stakeholders, right? The communities, the clients, and regulators. And the work has become much more complex. So basically, before you took a look in the company and then you saw what would drive that company in terms of competitive advantage and things like that. But now you need to take care if the employees are well treated, if you don't, if the turnover is high, if they have accidents in the company, eventually you treat your clients badly, you're going to lose your clients. And a lot of data now is available. So we take a look on data that the company provides, but also we look at the very other sources of data that will either make the argument of the company stronger or make it weaker, and then we make a decision. So we do believe that the sustainability for the future, you need to take a look on all these aspects in order to do that, to find the best opportunities and also to mitigate the risks. We have like this approach of integrated, which act to avoid harm, sustainable, with benefits to stakeholders and target impact products. So we're kind of trying to lead the way as well in terms of how you solve some issues, right? And we do use the ABC framework in order to do that, in order to frame some products and how we're going to communicate that to clients. So it's very important as the initial remarks and how we communicate that to clients so they understand what's happening. We do have this kind of thematic approach as well in terms of this SDG goals and inclusion, sustainable infrastructure. So for different asset classes. So engagement is also very important. No company is perfect, and you need to take a look on how we focus our engagement in terms of all these aspects of the citizens, the community, how you allocate capital, how you treat fairly your employees, your suppliers, and your clients, and the well-being of the environment, right? So at the end of the day, we need to take this approach on a very, very disciplined way, that's why it's hard to do that without a lot of resourcing. So we need the resourcing from the analysts, we need the resources from the team. And we do rely in a lot of tools and external rating companies and a lot of information from the market. But we have established two important tools internally through all the years. That one is Context, which pretty much is meant to increase the comparability between stocks in the same sector globally, which means we have the database in Brazil, the database in Asia or in Australia or whatever, and we do rely on a kind of disciplined fashion on how we're going to get the information from that company and from the market, and then we try to do a peer-to-peer analysis for that specific sector. So this is meant to not just also give us some more an insight on the investments, but also to see what went good and bad on that specific company and sector worldwide, but also to avoid the analysts who have bias to buy the company. So you may have a situation whereby have the same kind of companies in different countries working kind of the same standards in terms of ESG, and then one analyst kind of provides a good rating in one company that has the same conduct and the same aspects of the other company. So then the ESG team is going to say why you're kind of rating this company better than the other one that's kind of doing the same practices. So it's going to help us to make a kind of common denominator and have a much better view of what's happening in the market and to avoid biases in the investment process. And then we have the SustainX, which is pretty much a quantification analysis of the ESG aspects, trying to measure what's going to be the benefits and what's going to be the cost for the society, for the environment, and so on and so forth, and trying to identify, the future risk not priced yet, because it's like you're running for an insurance policy when you already have a flood. Before the flood, probably the insurance policy premium was much lower than after the flood. So it's how we're going to do that in order to make it quantifiable and make better investment decisions. So the context, is a kind of bottom-up ESG aspect. So we get a lot of trends, we get stakeholders, we get all the metrics we're going to use, and we have over 260 data points here, and then we have the ratings in order to give us a little bit of a qualitative and quantitative analysis, and then we have the insights about how these issuers and the companies are kind of performing in terms of their specific sector. So this kind of slideshow that we see that what is the tool calculated score and what the analyst calculated score. So we have quantitative analysis, and we see this company in the context of the other companies. That's why the context tool is named this way. And then it's a kind of a snapshot of what we do. So for certain companies, we have a set of questions and a set of learning experience and know-how of what we need to question, what we need to answer, what we need to address. So it's not the analyst is going to call the company and make the questions he wants. We have a kind of detailed roadmap of what needs to be done in terms of customers, employees, and suppliers, and so on. And then we have the scores, and then we have a look if the performance of the company and against the data and the analyst analysis in terms of what they believe about the company is going to score the company better or worse. And again, the ESG, the Sustainalytics is kind of the same, but we use more than 400 academic studies trying to map and monitor things. We have more than 70 data points for each company we analyze, and when we have more than 10,000 globally companies, companies globally. And then we try to measure what the kind of benefits to the society, such salaries, benefits, innovation, donations, and then how we use carbon emissions and alcohol production, and also how the communities are treated, and so on and so forth. So we try to quantify this in a much precise way, so we also can communicate better to our clients. So we see how we have the portfolio, what the benchmarks composes in terms of emissions, carbon emissions, and we're kind of acting in a way that's going to have less carbon emissions or not compared to the benchmark, and how we do that also against sectors. So it's very much a quantitative analysis in order to provide better insights. We see that in different ways of exposure. In the past, a lot of analysts said, especially in equities, what's your major risk? And very likely they would come back and say, this is the company A, which has 10% or 20% of our portfolio. For a period now, we already see that it's not necessarily the amount of how much the company represents in the portfolio as a percentage of the NAV, but much more like what does it contribute to your risk. So we do have what's the risk to that company on that portfolio based on the contribution to tracking error, things like that, on a kind of more ex-ante basis. And now we also see that in terms of, okay, what are the impacts in terms of exposure, risks, and allocations, considering the stakeholders' interests, like environment, consumers, community, and about the ESG categories, or about this SDG. So we now have all these kind of tools in order for us to have better decisions and insights in the best interest of our clients. And finally, the two slides is about, we need to communicate that properly to clients, right? We need to go to clients and say, this is the scoring, this is how we score, these are the companies we buy, this is why we bought, this is kind of how we engage with these companies. And so we try to make kind of comprehensive analysis of what we are, delivering by doing that. And we need to keep that in mind, that whenever we say that's sustainable investments, you still have sustainable and still have investments in the same sentence. So you have a kind of a coin that you have like a flip side, which one is the investment risk to the sustainable goal, and the other one is like, what's the sustainable risk to that investment goals? Because if you do kind of ESG process that you're going to exclude certain companies, like in Brazil, for example. In Brazil, 20% of the benchmark is commodities driven, right? So if you exclude the commodities from the benchmark in a kind of ESG approach, you're by definition have a kind of a 6% or 8% tracking error in your portfolio, and the clients need to know that. So basically, if you have a kind of commodity rally, probably the portfolio is going to underperform the benchmark. So it's important that the clients have a very clear view of what is driving the returns and what you're trying to achieve by doing that. So that's why we have this ABC framework in trying to show the clients why you're doing this And if they want certain things that are going to be a little bit more thematic, like climate change and things like that, they know that there's a risk of other things to happen, and that specific fund underperform or outperform the benchmark. But there's a lot of caveats on doing that, because, you know, for example, when you do that against the MSCI, it's easier because you do have a much wider and more broadly diversified benchmark, right? You have 1,600 stocks, or in all countries you have 3,000 stocks. In Brazil, you nearly have 100. So if you do that with 100 stocks in Brazil, pretty much, and then you have 20% that's commodities, right? Clients need to understand there's a kind of investment risk, that's sustainability goal, right? And I think one of the things that we have been seeing before I finish, and I think that's going to be just a kind of a hint for our panel, is like the market in Brazil is kind of the industry in Brazil is doing a lot in terms of getting much more of the do's and don'ts and the how can I say framework how we're going to operate. It's not going to be a copy and paste from any other jurisdiction, because Brazil is different in many ways. We have a lot of idiosyncrasies here in Brazil. However, I think that's going to be inspired. So probably the you know, just the trading industry, the self-regulatory body, and the regulatory agency, they don't want to reinvent the wheel. And the good thing about that is, like, we can learn from the experience that from the ones that are already ahead of us. So I think that this is coming to a good end in Brazil, but we're still in the very beginning of that. I'm also a member of the sustainability committee of the trade association in Brazil. So I think we are going in the right direction, but it's a lot of things to be done yet. But I think this specific thematic about the ESG trends is that for us in the future, like we had the risk-adjusted returns, we are going to have the ESG, the risk-adjusted returns, and the returns as a kind of embedded to the process. You know, it's not that, it doesn't mean that all funds are going to become ESG, but it means that investment processes are going to take this into account in a much deeper you know, degree. And that's why, and I think that Aldo also mentioned that, you need a lot of resources to do that, because we do take an active approach, right? So we do take an active approach, because one of the things that to finish that we saw that, you know, that's why we had this to develop these tools, is like, if you come to an analyst or a portfolio manager and say, you know, this company is rated this, that's why you need to buy or sell, the guy's going to say, no, why is that? You know, open me the black box, I want to know. And then normally, even our tools, there are some disagreements about how we're kind of rating or grading certain topics. So I think that taking the active approach is quite important, because the world's very complex now. We have a lot of you know, forces kind of coming from even the regulator. You have an abuse with your clients, the regulator is going to change the regulation and so on. So in one shot you can kind of cripple the company future. So I think that having all these tools are going to become even more important every day. And that's why I think that you need to have scale, you need to have resources to do that properly to your clients.
Daniel, thank you very much for your time, for your comments. Thank you for sharing with us the extensive capabilities you have been building throughout the years, and also the challenges of adding ESG factors to investment analysis. You need extensive tools, systems, processes. It is worth it, but it is not easy, right? And now we are coming to our last speaker. Bridget Fawcett is Managing Director, Co-Head of Sustainability and Corporate Transitions at Citi, a company we all know and who has extensive resources in the region and has done so much in this aspect. So Bridget, thank you very much for being here with us. It's all yours.
Terrific. Well, thank you, Barbara, and thank you to the CFA Institute, led by Chris and Marvin, for hosting today's event. As you mentioned, Barbara, we are honored to be here because we have, Citi has had a presence for over 100 years in Latin America and over 50 years in the Caribbean region. And we have over 400 professionals really across the region focused on banking, capital markets, and advisory work for our clients, really across investor, corporates, and the public sector. And like my fellow panelists that have already spoken today, we've been on a sustainable journey for more than 20 years. and we really continue to advance our leadership and partnerships with our clients. But as many of my other panelists have noted, we are on a journey. This is hard work. We think that we're really in the very beginnings of a fundamental paradigm shift in terms of how we all operate. And the scale and pace of what we all have to do collectively is sometimes overwhelming. But we really appreciate all of the opportunities that we have in the region. We are pleased to announce that we rank top of the league tables in Latin America's sustainable debt markets. We've led over half of all of ESG labeled bond offerings this year, and most notably for this audience, we just recently led sustainability linked bond offerings for San Miguel Industrias, or SMI, just in the last 2 months, as well as NIMAC, a Mexican auto parts manufacturer sustainability linked bond. So thank you for having us today. I thought what maybe we could do, what we would say in the US, is I can play cleanup batter and really just synthesize maybe some of the things we've heard from others, and then just touch upon the capital markets angle as we go forward. So just bear with us as we get organized. We've got the slides up, so thank you for that. And maybe just to flip to the really, this is the takeaway page, thank you. We can just focus on some of these emerging trends. They've really already been highlighted by my colleagues on the panel, but I think it's important to take a step back and just think about what's really happening broadly. And that is that climate change, the fact that we're gonna have 2 billion more people in the world over the next 20 years, the fact that we are hit a tipping point shift of digital disruption has really created a sustainability revolution with major secular transitions underway that really are presenting major system risks that are global and they're interconnected. And this is not just the energy system transition that we all know about that's driving the race to net zero that I'll talk about in a moment, but we're also seeing fundamental shifts in our agriculture and food systems, in the circular economy at large, digital awareness and efficiencies that are disrupting business models, the move for our cities to be smart and clean, and certainly really important fundamental shifts in the financial system, really trying to reroute capital to be more inclusive and equitable. So we think that the major system shifts that are underway are super important and critical for how we comport ourselves over the next 10 and 30 years, but they do require interdependencies for the public and the private sector. And I think, as many speakers have already alluded to, the pace of change really does vary across regions and across constituents. And I think it was maybe Aldo who said that investors are ahead of corporates right now, and we see this just globally, that when we look at the change that's necessary to have a sustainable world, that corporates are a little bit behind, and that investors are really leading the way with this shift. And I think you've heard that today from others. So maybe what we could do is just touch upon a couple of these themes, and then we'll do a little bit of a quick deep dive with other slides on the capital markets piece. But I think importantly, when we think about the major trends that are really driving capital, driving cost of capital and access to the markets, we think that the net zero by 2050 trend is really becoming table stakes for corporates and for investors. And that in this shift that's really being intensified by COP26, and the focus on net zero commitments by governments. This is really going to accelerate capital towards low carbon businesses. And maybe if we go back for a moment with the slide, we'll go into deeper in some of these trends. But I think important about this shift is that this is something that all companies are going to really have to adopt, and it's really going to have fundamental impact for supply chains and how we really reach a low carbon net zero world by 2050. What's coming along with that is the green recovery around the world, where we're seeing governments really land in on their commitments to net zero, which is then cascading down to corporates and really creating a green recovery agenda that's really impacting policy regulatory agendas, growth agendas, and it's ultimately creating, rightly so, a greater focus on individuals, on people, on a just transition. And this is translating also into corporations and how they're now more focused in certain parts of the world on the S, or as focused, I should say, on the S part of ESG as they are on the E. Of course, coming and critical to all of these trends, which I think we've gone into detail today about, is the harmonization that's necessary for reporting standards and disclosure frameworks. And there's a lot of good work going on with the World Economic Forum, with SASB, and many other regulatory bodies, the SEC in the US, trying to come to harmonization of what reporting standards are, because this is probably the most complicated piece for corporates when they look to investors and they're trying to match what investors' needs are with what they need to report and how they pretend themselves. The other big issue that we're not going to really get into and delve in today, but is biodiversity and nature capital. And we really believe that this is the next net zero. And with the COP15 summit coming up on nature and biodiversity in China in October, we think that this is akin to what the Paris Accord was for climate. So I think that this is something for folks to keep on their radar around the requirements that will be necessary and the disclosures and the risks assessments around biodiversity. I think importantly, Citi, just to exemplify or evidence some of these big trends, we have joined the Net Zero Banking Alliance. So we have committed to a net zero by 2050 goal. This is really putting a whole new set of responsibilities on us. And we've become part of the broader Glasgow Financial Alliance for Net Zero. And we're going to talk a little bit about what that means for all financial institutions that have joined that. And importantly, we've also committed to $1 trillion to fund sustainable finance by 2030, both social and environmental. And we're pleased to say just last year that in 2020, we have deployed over $1 billion to Latin America for our 2020 commitment. If we flip the page, let's just quickly go through a level set of some of these. I think the most important probably takeaway today from my perspective is that there is 90 trillion of capital moving to low carbon and transition businesses. Margaret talked a little bit about the ETF rise in growth that's been so important. But if we think about ESG assets under management broadly, even beyond the ETFs, we're at probably about 35 trillion today. With the Glasgow Financial Alliance that I referenced earlier, this is now 250 financial service providers across the world, 70 asset owners and insurers, 53 banks, and 128 asset managers that control collectively almost 90 trillion of assets under management and capital. And the rules of the road for joining the GFANS for net zero is that these institutions now have to report not just a 2050 net zero goal, but what their pathway goals are for their portfolios by 2030 and by 2025. So there are short-term and medium-term goals that actually are going to be publicly announced by this group of members. The memberships are growing, and this is going to really dictate how they think about allocation of capital, about funding businesses that are transitioning and that are low carbon. And so this presents incredible opportunity for those businesses that are emerging and growing. And it also presents opportunity for those companies in harder to abate sectors that need funding to transition. But this is really going to dictate very much as we move forward the cost of capital, the access to capital for businesses. Maybe if we move on, and we can certainly answer more detailed questions in the Q&A. I think importantly, investors are really receptive to sustainable, resilient businesses. You've seen this from other charts presented today. Those companies that have ESG, and this is really based on 9,000 global companies. If you have, based on Citi's own proprietary insights, as well as third-party rating providers, if you have a strong ESG profile, i.e. low risk, and you are well managed across all E, S, and G components, you tended to outperform pretty dramatically relative to those companies in your industry that are considered weak. So the equity cost of capital, so to speak, for strong ESG profile companies is really significant. And it is what is also going to garner how investors, and I think you've heard it today, think about businesses. Congratulations to Aldo. AFP Integra is in that top strong quartile box, really with outperformance from a financial relative to the other financial sectors. But there are a number of Latin America companies in that strong quartile, really across the consumer, industrials, and power space. And so we can talk more about that, but this is a very compelling reason for companies to think about accelerating their sustainable strategies, because there is an inherent benefit to cost of capital. If we quickly flip to the next slide, this also just playing out in the debt capital markets, and this I think was referenced earlier on, that the debt capital markets globally have evolved to include a diversity of sustainable products. We might think of historically this really emerging with the green bond, but this is really now debt capital markets have evolved into really allowing companies to issue social, sustainable, and sustainability linked bonds, all with varying different rules of the road around those constructs, and being really more oversubscribed in the marketplace today than regular way bonds. There's a real demand supply imbalance, and you can see that just the tremendous growth that's happening, not just globally, but also in Latin America, through the sustainable issuances. And you can see some of the recent issuers, and I referenced some in the beginning. Again, playing back to the cost of capital theme. If we flip the page, we'll just talk about the importance of social. Here are some examples of European, US, and Latin America governments and corporates that have started to use the capital markets to also fund their social agendas. And you can see that the use of proceeds really range from funding affordable housing, providing, driving racial equity initiatives at the company, driving gender diversity initiatives, or empowering women for entrepreneurial efforts. So this is a really important toolkit for companies. When you think about your sustainable strategy and driving authentic strategies, you can start to use the capital markets to fund components of those strategies. If we just move to the next slide, we'll wrap up here by just saying that Citi, as I already mentioned, has really allocated and committed $1 trillion to sustainable finance by 2030. This is really across environmental finance and social finance. And I think what's compelling about this is it really dovetails into some of the new emerging sectors that are coming out of the sustainable paradigm shift. And if we flip the page as the last slide, we're happy to, as I said before, that we have a leadership in Latin America's sustainable debt markets and are doing a lot of work across many different countries, sectors, and governments around trying to provide capital to support broader sustainable strategies. So let me stop there and turn it back over to you, Bart.
Sorry, I was muted. Thank you very much, Bridget, for this quick summary, for highlighting the major sustainability ESG trends that we are all facing, and this $90 trillion in money coming into this sector. This is a tectonic shift. And also for showing how it makes so much sense to invest in ESG, because for companies focusing on this are having better risk-adjusted returns, are outperforming. And thank you also for adding this Latin American flavor as you all did. So we have a little bit less than 10 minutes for closing questions and to take some questions. And I would like to start asking a question that wasn't directly to me, question to Margaret. How can a company be included in one of your indexes? How do you get a company to be analyzed by you? And can you share that questionnaire that you use?
So I'll answer that question in two parts. So first and foremost, inclusion in one of our indices is dependent, obviously, around the index methodology and the parent index as well. So for an index like the S&P 500 and ESG index in particular, first and foremost, you would have to be a constituent of the S&P 500 to be eligible for inclusion, and then meet the specific thresholds and sustainability requirements that have been designed or outlined in the index methodology. But one of the kind of barriers to entry is the fact that there is a present ESG score, which is acquired through that corporate sustainability assessment. So even though, only about, 3,500 or so companies were invited to participate in the corporate sustainability assessment, we do have coverage of up to about 10,000 companies. And that is because we can use as much public disclosure as possible to fulfill the corporate sustainability assessment and the questions within the assessment using that disclosure data. So there is a wider coverage universe, but we do, again, invite, 3,500 companies last year, 5,000 companies this year to participate in that corporate sustainability assessment. So if you are interested in engaging with us on the corporate sustainability assessment, there's an entire team at S&P Global that is willing to engage with you, speak to you, and provide some direction around what that corporate sustainability assessment process is. And we do also provide what I call a handbook that it looks at the criteria, some of the questions that are asked, and provides a pretty detailed overview of what you would encounter if you did decide to proceed with engaging with us on that assessment. So as follow-up, I'm always happy to provide any of that and direct you to the right individuals on our team. I hope that answered the question.
Yes, thank you very much, Margaret. And I invite you all to maybe share some closing comments, but also a question. It is very clear that this is a trend, the importance, wherever you look at, this is very important, front and center, and we have the opportunity as a sector to lead, to make a difference. But companies are struggling to see, how do I report? Where do I start? And so this is still evolving. So for companies that want to make a difference, where do they start? Who would like to take this?
I'm happy to start it and then have others jump in. I think that this is really a great question, and I think one of the things that we've seen in talking to companies across different sectors and in different regions and countries is that there's a real will to win in this area, and that's often, but they don't know how to get going. And many times, even global multinationals have excellent cottage industry focuses across sustainability, but they haven't really consolidated those efforts really at the top of the house, so to speak. And so one of the things that we always advise companies is that you have to be true to yourself, and you have to be core to sustainability has to be core to your overall strategy, not a separate report that you issue every year. It really has to be embedded in what you do and authentic to who you are. And one of the ways to be able to start that process, we think, is really through the, I think it was Margaret or Aldo who put up the slide around the risk assessment framework from SASB that really starts to highlight the different components of risk for your industry and the importance of those risks to your stakeholders, and really going through that risk assessment process where you're starting to identify what matters to you as a business, what matters to your broader stakeholders, and starting to prioritize what that looks like is a good way to start to buy in, to get broader stakeholder buy-in to the strategy that you then embed in your overall corporate strategy. There's lots of other things to do because then you have to set goalposts and guidelines and metrics around that. But I'll stop there and let Danielle or Aldo or Margaret chime in from that process.
I can go on that. I agree with Bridget that you need to be true to yourself. I mean, this is not about just filling a report to have a checkbox in your end of year objectives. Sustainability needs to be core part to your strategy, and you need to start with the board. I mean, the board needs to be fully committed on what you are pursuing as management. And in order to have a feeling of what you need to do, I think what we have achieved in Peru is I think it's a good way to go. When we went to issuers to ask them, okay, I need to see what you're doing on ESG, and I need you to answer these questions. So we went as Integra, and then the other pension funds went with another questionnaire, and then they have the questionnaire of the regulator and the one of S&P, and so there were a lot of questionnaires, and there's a lot of confusion for the issuer, and different issuers are in different stances. So you don't need to fill everything. So we work with the regulator to make a very standard report on social and environmental. Governance has a different report. So we start with a report which has around 35, 40 questions, very simple questions, and that's the way to start. And the other thing I think is very important, it's that answering no to a question is not bad. What you need to do is to really reflect where you are and what is your plan. I mean, we do not expect every single company. We probably as Sura, we do not answer yes to every single question. And so this is not about having 100% score on each question. It's about knowing where you are and to share with markets, share to investors, share with clients where you want to go and what's your plan to reach where you want to go in every year. You're not going to change everything in 12 months. This is a journey that it's not easy, it's long, but the fact of improving and sharing with markets, with clients, with your collaborators, that's key in order to really pursue the objectives you are really setting.
Thank you very much, Aldo. So basically in Peru, you're doing one questionnaire with a local flavor. This is what you're pursuing.
Yeah.
Because so my final question here, because this is something that's coming up, there are so many reporting standards and everybody has its own reporting. And so any recommendation as to that for those that are not in Peru?
Yeah. I mean, I think that there's a lot of work being done right now on the standardization of reporting across E, S, and G, and the World Economic Forum has worked with the 4 largest global accounting firms to start to look at best of breed reporting metrics that are out there and to help to organize them into 4 pillars of prosperity, people, planet, and I'm forgetting the 4th P right now, but somebody will remind me.
Profit.
No, not profit. But anyway, we'll
profit.
Yeah, I think the important piece is that within those verticals, there are identified core metrics, core standard metrics that every company should aspire to report on. That work will evolve, but that's really being rolled out right now as one way to start to create a standard, leveraging all of the great reporting tools and frameworks that already exist. There are some that are quickly becoming the standard. For example, TCFD reporting is becoming kind of the gold standard for climate risk reporting. And you're going to soon see that the launch of the TCNFD, which is the nature and biodiversity reporting that may very well follow the TCFD reporting. So if you're thinking about what do you do for climate risk, I would suggest everybody to go look up the TCFD guidelines and how you would report to that. It's going to become potentially required reporting for certain jurisdictions, certainly for issuers and investors alike as we move forward. But that would be one example of a good standard climate risk reporting framework.
Thank you very much, Bridget. And if one of the panelists would like to do some closing comments, please jump in. Otherwise, as our time is due, I would like to very much thank you. Thank you for all that your knowledge, what you're doing, how you're doing, and it was a great experience for me, and I learned a lot from listening to you. So Thanks again. And now I'm going to give the floor to Íñigo Bengochea, the Senior Director of Government Affairs in the Americas region at CFA Institute. And I leave you also, Íñigo, with a question that came from the panelists, but I think it's for you. And they say, would like to ask if there's available any data about the impact of the new CFA Institute, CFA Society UK certification on Latin America. How many people are taking it? Thank you.
Thank you, Barbara. That's a great question, and I'm happy to report that we had about 500 people already signed up in Latin America. Please continue to show interest and sign up if you're interested. And it's taking flight, so don't miss the opportunity to sign up for the test. With that, let me say thank you, and I'm going to provide our event's concluding comments today. This was our first ESG Summit in Latin America and the Caribbean, and I would like to express my gratitude to our speakers, in particular, Margaret Dorn, Aldo Ferrini, Daniel Celano, Bridget Fawcett, Barbara Meinzer, Chris Fiddler, and Melvin Escudero. As we all try to manage the ESG trends that are occurring in the region, I think you'll agree that our panelists' insights and perspectives were extremely helpful today. And I'm sure our listeners appreciated the quality of the discussion with these senior industry figures. Their insights provided a great level of detail as to how ESG changes are affecting investors and businesses. I hope their viewpoints aided in your understanding. As I stated earlier, this was our first regional ESG Summit, and it's part of a series of webinars we're hosting across the region this year. The series is the outcome of 13 CFA Institute societies in Latin America and the Caribbean coming together to put this series. This type of webinars would not exist today if these societies had not collaborated. As a result, please accept my heartfelt congratulations to our respective societies and to our volunteers, especially Melvin Escudero and Hugh Miller, who are the chair and vice chair of our Regional Advocacy Council. The good news is that our Mexico and Colombia policy series will take place in early September, and we'll hear from policymakers about their regulatory agendas in these subsequent webinars. In addition, we are putting together a GIPS event, as well as the Asset Owner Series 2nd edition. Please stay tuned as we collaborate to bring you industry luminaries to talk about the topics that are important to investors. With that, let me thank you again and have a good rest of the day. Thank you, guys.
Thank you.